On the 5th of October, one of the world's biggest exchanges starts trading a new contract. Not oil, not wheat. The price of renting a graphics card for a month. A second exchange has announced its own version of the same thing. Compute is being turned into a commodity, in public, on a date, and the people who own the actual machines haven't agreed to any of it. A futures market needs two people. Someone who wants to lock in a price, and someone who has to sell one. So far, only one of them has shown up. That's happened before, and it didn't end well. First, why anyone would want this at all? Renting an Nvidia Blackwell card cost $2.75 an hour in the middle of February. By mid-April, it was $4.08. That's a 48% jump in 60 days, on the thing every AI company is built on. And buying it on the spot market now costs at least twice what a contract does. A price that moves like that can bankrupt you. A training run booked at $2 an hour and delivered at $4 has doubled its cost, and nobody made a decision. Small labs are already getting squeezed out, and the cheapest provider in the market just raised its prices several times over. When a price gets that violent, somebody always builds a way to bet on it. If this is useful, hit like. It genuinely helps the channel out. And subscribe, so the next one finds you. So what are they actually selling? A futures contract is a promise about a price on a future date. Here, each one stands for a month's rent on a single graphics card, the H100, and the newer B200. Nobody delivers a card. It settles in cash against an index of what renting one actually cost, which means the index is the product, not the chip, the number. And here's the problem. A commodity market only works if the thing being traded is interchangeable. A barrel of West Texas crude is the same barrel wherever it comes from, and that's the whole reason the market functions. So what's the equivalent for compute? An hour on a card in one data center isn't an hour on the same card somewhere with worse networking, worse power, a longer queue. Critics keep asking the obvious question, and there's no clean answer yet. What's the West Texas intermediate of compute? So who quietly wins if this works at all? Not the exchange. It earns a fee, like it does on everything else. The company that publishes the number. Every contract on either exchange settles against somebody's index, and that somebody collects forever, without owning a single machine. There are two candidates, and almost nobody has heard of either. So who's actually shown up? The company publishing the index for the bigger exchange was seeded by WWN Jump Trading, two quantitative trading firms. And when it raised money again this month, the exchange itself was one of the investors. So the venue, the number its contracts settle against, and the firms trading them are all one small circle. Read the exchange's own list of who this is for. Traders, financial institutions, then AI builders and cloud providers. The financial side didn't just turn up to this market, it built it. And somebody has already opened one. Since January, a smaller venue has been trading contracts on GPU and memory prices, built on the same index provider the second exchange just partnered with. Read who it says it's open to. Hedge funds, market makers, family offices, asset managers, insurance companies, lenders. Every one of those moves money for a living. Not one of them owns a graphics card. And I want to be careful here, because that's an absence, not a fact. As of today, no exchange has publicly named a single company that sells GPU time as a participant. That's not the same as saying none of them will. But it matters, because the sellers have a reason to stay away. Spot is running at twice the contracted rate. That gap is the business, and a public forward curve is exactly the thing that closes it. And this has been tried before. In December 1999, Enron and Global Crossing did the first trade in a new commodity, bandwidth. Same pitch. Take a technical service, standardize it, trade it the way energy is traded. It failed. And not just because the dot-com crash buried the price. It failed because the phone companies who owned the actual fiber wouldn't join. Hooking into that market meant turning their product into a commodity and losing control of what they could charge. The traders were ready. The owners never came. Now, the case against everything I've just said. Weather derivatives worked. Freight futures worked. Both got called unworkable for the same reason. Too specific, too hard to standardize. And both are ordinary markets now. So nothing here is faded. And no names in August isn't a refusal in October. One press release naming a big seller turns this whole argument around. The question isn't whether traders want this market. It's whether the people who own the machines ever agree to be priced in public. So that's how it works. Now the call. Dated, named, and with the thing that would kill it. But first, the part that makes all of this slightly absurd. The shortage isn't the chip. It moved. What everyone's short of is the memory that sits on top of the processor, stacked, bonded, on lead times of 36 to 52 weeks. And the advanced packaging that puts it together, booked out past the middle of next year. A futures contract can't make memory. It can only reprice the queue, which means the actual rent from this shortage gets collected by the companies that bolt those stacks together. So here's the call. By the 31st of March 2027, compute futures are trading as a speculative instrument rather than a hedging market. Open interest, sitting with proprietary trading firms, and no neocloud or hyperscaler having publicly disclosed that it hedges its own capacity on either exchange. And the leg that makes it killable. If a named seller of GPU time discloses hedging on either contract, or an exchange attributes real open interest to commercial rather than financial participants, this call is dead, and will say so. So who does that actually point at? Here's the simplest way to think about it. If everyone suddenly needs taller stacks of memory, the money doesn't go to whoever owns the chips. It goes to whoever makes the machine that stacks them. That's a much smaller group of companies, and almost nobody outside the industry has heard of them. Start with Hanmi Semiconductor. They're Korean, and they make the machines that press memory chips together into a stack, heat and pressure, layer onto layer. Here's why that matters. A futures contract can't make memory, but every extra layer somebody wants is another pass through one of those machines. They sell the tool, not the chip. I'll be straight with you though. That's me reading the structure, not a number Hanmi has published, and it says inferred on the card for exactly that reason. Then there's B Semiconductor. Everyone calls them BESI, out of the Netherlands. They do the next version of the same job, called hybrid bonding. And the interesting part is that it stops being optional. Past about 12 layers, pressing the chips together starts to fail, and you have to bond them directly instead. So the taller the stacks get, the more the industry has to buy the harder machine. Same caveat as before. That's a structural read, and it's marked as inference. And then 2, I'm naming for a completely different reason. CME and ICE are in here because their filings are the hardest evidence in this story. Not because I think there's a trade in them. They're huge. Everyone already owns them, and they're already priced. The index publishers, Silicon Data and Orn, are the real toll booth, and you can't buy either one because both are private. And the company I'm deliberately not pointing at is the chip maker. Nvidia is what the index measures. It isn't a winner from this market existing, and it's already the most widely held stock on Earth. So, plainly, 2 exchanges have built a market for the price of compute. The traders are named. The sellers aren't. The shortage this market is meant to price isn't in the chip, it's in the memory stacked on top of it, and no contract can manufacture that. In 1999, the same idea died because the people who owned the wires wouldn't be priced in public. That's on the record. Today, the 13th of August, 2026. First checkpoint is the 5th of October, when trading opens. Then the 31st of March. We'll come back to it either way, including if it goes against us. A market needs someone who wants to be there, and someone who has to be. Right now, this one has plenty of the first. Watch for the second.